Assalamu alaikum and good day everyone. My name is Madam Faiza Binti Sahbuddin, a business finance lecturer from Polytechnic Metro Johor Bahru. Today, we will be discussing an essential topic in financial analysis, which is financial analysis ratios. These ratios help us assess a company's financial health and performance. We will cover 4 key categories, that is liquidity, activity, leverage, and efficiency ratios. To make it more practical, we will use an example of the statement of comprehensive income and statement of financial position of a company. Let's take a look on the statement of comprehensive income and statement of financial position for XYZ company. First, let's look at liquidity ratios, which measure a company's ability to meet short-term obligations. 2 key ratios are the current ratio and quick ratio. But before we dive into liquidity ratios, we first need to understand 2 important financial elements, that is, current assets and current liabilities. Current assets refer to cash and other assets that a company expects to convert into cash within a year. Some example of current assets are cash, inventory, account receivable, prepaid expenses, and short-term investment. While current liabilities are the company's short-term obligations that must be paid within a year. Some example of current liabilities are bank overdraft, account payable, accrued expenses, and short-term loans. Now, let's move on to discuss these ratios in detail. Current ratio. The formula for the current ratio is current assets divided by current liabilities. From the question earlier, the company has current assets of 50,000, 60,000, and 90,000. When added together, the total current assets are 200,000. The company also has current liabilities of 40,000 and 50,000, which add up to 90,000. To calculate the current ratio, we divide 200,000 by 90,000, which gives 2.22 times. A ratio above 1.0 indicates the company can cover short-term liabilities with current assets. Quick ratio, also known as acid test ratio. The formula for the quick ratio is current assets minus inventory divided by current liabilities. In this case, the company's current assets are 50,000 and 60,000, and its inventory is 90,000. To calculate the quick assets, we subtract 90,000 from the total current assets, which gives 20,000. The current liabilities of the company are 90,000. To find the quick ratio, we divide 20,000 by 90,000, which gives 0.22 times. A quick ratio of 0.22 means that for every 1 ringgit of short-term debt, the company only has 0.22 ringgit of quick assets to pay it off. Next, we have activity ratios, which measure how efficiently a company manages its assets. Let's go through 4 important ones. Inventory turnover ratio. The formula for inventory turnover is cost of goods sold divided by average inventory. In this case, the cost of goods sold is 300,000 and the average inventory is 90,000. To calculate the inventory turnover, we divide 300,000 by 90,000, which gives 3.33 times. This means the company sells its inventory about 3.33 times per year. Average collection period. The formula for the average collection period is accounts receivable multiplied by 365, then divided by sales. In this case, the accounts receivable is 60,000 and the sales is 500,000. To calculate the average collection period, we multiply 60,000 by 365, then divide by 500,000. This gives 43.8 days. This means it takes about 44 days to collect payments from customers. Total assets turnover. The formula for total asset turnover is sales divided by total assets. In this case, the sales are 500,000 and the total assets are also 500,000. To calculate the total asset turnover ratio, we divide 500,000 by 500,000, which gives 1.0 times. This indicates that each ringgit of assets generates 1 ringgit of sales. Fixed asset turnover ratio. The formula for fixed asset turnover is sales divided by fixed assets. In this case, the company's sales are 500,000 and its fixed assets are 300,000. To calculate the fixed asset turnover ratio, we divide 500,000 by 300,000, which gives 1.67 times. This means the company generates 1 ringgit 67 sen in sales for every ringgit of fixed assets. Moving on to the third ratio, that is leverage ratios, which show how much a company relies on debt. Debt ratio. The formula for the debt ratio is total liabilities divided by total assets. In this case, the company's total liabilities consist of 40,000, 50,000, and 150,000, which add up to 240,000. The total assets are 500,000. To calculate the debt ratio, we divide 240,000 by 500,000, which gives 0.48 or 48%. This means 48% debt ratio shows moderate financial leverage. Times interest earned. The formula for times interest earned is operating profit divided by interest expense. In this case, the operating profit is 120,000 and the interest expense is 20,000. To calculate the times interest earned ratio, we divide 120,000 by 20,000, which gives 6 times. This shows the company can cover interest expenses 6 times over. Debt to equity ratio. The formula for the debt to equity ratio is total liabilities divided by owner's equity. In this case, the total liabilities are 240,000 and the owner's equity is 260,000. To calculate the debt to equity ratio, we divide 240,000 by 260,000, which gives 0.92. A ratio below 1.0 indicates a balanced capital structure. Finally, let's look at efficiency ratios, which assess profitability and return on investments. Gross profit margin. The formula for gross profit margin is gross profit divided by sales, then multiplied by 100. In this case, the gross profit is 200,000 and the sales are 500,000. To calculate, divide 200,000 by 500,000, then multiply by 100. The result is 40%. A 40% gross profit margin means that for every 1 ringgit in sales, the company earns 40 cents in gross profit after deducting the cost of goods sold. Operating profit margin. The formula for operating profit margin is operating profit divided by sales, then multiplied by 100. In this case, the operating profit is 120,000 and the sales are 500,000. To calculate, divide 120,000 by 500,000, then multiply by 100. The result is 24%. A 24% operating profit margin means that for every 1 ringgit in sales, the company keeps 24 sen as operating profit after deducting both cost of goods sold and operating expenses. Net profit margin. The formula for net profit margin is net profit divided by sales, then multiplied by 100. In this case, the net profit is 80,000 and the sales are 500,000. To calculate, divide 80,000 by 500,000, then multiply by 100. The result is 16%. A 16% net profit margin means that for every 1 ringgit in sales, the company keeps 16 sen as net profit after deducting all expenses, including cost of goods sold, operating expenses, interest, and taxes. Return on assets. The formula for ROA is net profit divided by total assets, then multiplied by 100. In this case, the net profit is 80,000 and the total assets are 500,000. To calculate, divide 80,000 by 500,000, then multiply by 100. Thus, we will get 16%. A 16% return on assets means that for every 1 ringgit in total assets, the company generates 16 sen in net profit. Return on equity. The formula for ROE is net profit divided by owner's equity, then multiplied by 100. In this case, the net profit is 80,000 and the owner's equity is 260,000. To calculate, divide 80,000 by 260,000, then multiply by 100. The result is 30.77%. A 30.77% return on equity means that for every 1 ringgit of owner's equity, the company earns 31 sen in net profit. In summary, financial ratios provide crucial insights into a company's liquidity, operational efficiency, financial leverage, and profitability. By analyzing these ratios, investors and management can make better financial decisions. I hope this session helps you understand the key financial ratios. Thank you for watching and see you in the next lesson. Bye bye and Assalamu alaikum.